Hi, everybody. Welcome to Friday's Focus on Finances. My name is Jamie Fleming, and today we're going to talk about 9 financial topics you need an understanding of. Navigating the world of personal finances can be confusing when you're just getting started, but let's face it, I've talked to thousands of people over the years, and even when you're raking in a 6-figure salary or generating 7 or 8 figures in revenue, people are still confused about many things in the financial arena. Unfortunately, most people weren't taught about finances in school. As a result of this, financial literacy across the country is far lower than it should be. First, remember there's no shame in not knowing or understanding. It's not your fault that you haven't learned about these important financial topics before now. However, it is your responsibility to take charge and learn about these topics and how they affect you. So in today's Friday's Focus on Finances, we're breaking down 9 important financial topics you need to have an understanding of. The first one, and no surprise if you've heard me talk at all, is the budgeting, or what I refer to as your spending plan. This is one of the most foundational financial topics of personal finance that everyone should know. In short, your spending plan is deciding how you'll allocate all of your money. It involves figuring out exactly how much you earn each month and where it's going to go. Keep in mind that budgeting or developing a spending plan is not about perfection. It's about the review. It's about your progress and implementation. If you struggle initially, over time, if you stay committed, you'll get better with budgeting and or developing your spending plan. There are lots of methods to utilize in this area. There's not necessarily one right way to budget. Instead, it's about finding the strategy that works best for you. There are several different budgeting methods that people have had success with. So we're going to look at some of the more popular ones. The first one is the 50-25-25 spending plan. I've modified this from the industry standard, which is 50-30-20 method. Based on my own experience and the habits of my higher net worth clients, this breakdown works really well to stay on track and create greater wealth. Using the 50-25-25 percentage spending system, you allocate 50% of your budget to needs such as housing, insurance, and transportation. 25% of your income goes towards wants, which could be eating out, shopping, traveling, and more. And then finally, 25% of your income goes towards savings and investing. With this system, I actually recommend saving and investing first, and then implement and allocate the remaining 75% as discussed. The next method is called zero-based budget. Using the zero-based budgeting method, you plan your spending by taking your total monthly income and allocating it to budget categories until you have a net of 0. The premise of the system is that you find a job for every single dollar, even if that job is savings or paying off debt. The pay yourself first method is also known as reverse budgeting. Using this method, you figure out how much you want to pay yourself each month, meaning how much do you want to put towards savings and debt goals. From there, you can spend whatever is left. This is a really popular method to start out with because you want to get in the habit of saving first. The old school system is the envelope system. And the envelope system is really good and works really well for overspenders. So it could be used in conjunction with any other type of budget. Using this strategy, you have an envelope for each spending category. In each envelope is the cash available to spend for the current month. Once the envelope is empty, you're done spending in that category for the month. Again, this is a little bit more old school. A lot of times people don't feel comfortable with cash, especially with the pandemic, but it's still a very viable method to use, especially like I said, if you're an overspender or you're having problems saving, this is a really good method to use, especially if you're a shopper. Now in today's technology, we have a lot of budgeting apps available to you. There are a lot of these apps on the market that can help you plan your spending and track your expenses throughout the month. Some of the more popular ones you can look up is Mint, You Need a Budget, Personal Capital, and an app called Every Dollar. There is absolutely no reason to not have a spending plan in place. Find the one that works best for you and stay with it. It does get easier with time and becomes a very critical financial habit to have and maintain. The next topic we're going to talk about is debt. I know this is the topic that everyone hates to talk about. Debt is more prevalent than ever in today's society. The data actually shows that debt has grown, consumer debt has grown to more than $14.9 trillion. And the average consumer debt is now at just under $93,000 in debt. And as it becomes more common, it becomes increasingly important to understand how to manage debt. So let's break down debt and take a look at it. First, we want to look at revolving versus non-revolving debt. Every debt is either revolving or non-revolving. Revolving debt is one where you continuously spend and pay off the debt. The most common revolving debt is, of course, credit card. And line of credit would also fall into this category as well if you have a line of credit on your home. Non-revolving debt is one where you borrow a lump sum and then pay it off over a specific term. Non-revolving debts include mortgages, student loans, personal loans, and car loans. The next thing to look at is secured versus unsecured debt. A secured debt is one that's secured by collateral or an asset the lender can seize if you don't make your payments. Mortgages on auto loans are secured debts since your lender can take your home or your car if you don't pay them back. Unsecured debts don't have any collateral behind them. The lender can still take legal action to get their money, but there's no asset they can seize from you. Student loans and credit cards are the most common examples of unsecured debt. So let's get a better understanding of your debt. It's important to know about and fully understand each debt you have. For each debt, you should know your total balance, the interest rate you're being charged, the minimum monthly payment, and your estimated payoff date. These are really critical pieces of information to have because you want to know how much your debts are costing you. Once you understand your debt, you can use a debt payoff method like the debt snowball, or debt avalanche to pay it off. The obvious idea here is that you need to have a game plan to pay off your debts that are keeping you from saving and investing in your future. You want to really have these laid out. I know it's not fun to look at your debt if you've gotten yourself into debt, but ignoring it is not going to help. And if you have a game plan, then you have a start and a finish date. So it kind of gives you hope at the end of the tunnel. The next area, which we've talked about before and went into great detail a couple of weeks ago, is your net worth. Your net worth is one of the most important aspects of your financial picture. Your net worth is simply the difference between what you own and what you owe. To calculate your net worth, start by adding up all your assets, which includes money in your bank accounts, your investment accounts, and physical assets like your home. Next, add up all your debts. Subtract your debts from your assets and you get your net worth. It's okay if your net worth isn't where you want it to be right now. Many younger people may even have a negative net worth as a result of student loans. The goal is simply to watch your net worth increase year over year. And over time, as you save money and pay off debt, your net worth will benefit from this. Think of your net worth when you're starting out as your before picture. Updating your net worth at least once a year will help you see your progress and make sure your net worth is heading in the right direction, meaning it's increasing. The next topic we're talking about today is credit. Credit refers to the ability to borrow money. But when people talk about credit, they're usually talking about either their credit report or their credit score. So your credit report is a full list of all your current debt accounts, including how much you owe, who you owe it to, and the monthly payments you've made in the past. It also includes possibly negative information, such as any accounts in collections and whether you've filed for bankruptcy. When lenders are deciding whether to give you money, they look at your credit report to see how responsibly you've handled debt in the past. The next area here is your credit score. So your credit score is a number between 300 and 850, which is essentially a numerical rating of your credit report. It's a snapshot of how responsible you are with debt. Here are the different scores, how the different scores fall on a scale of poor to excellent, and this is according to Experian. So if your credit score is between 300 and 579, that's considered very poor. You go up to fair between scores of 580 and 669. Your credit is considered good if your score is between 670 and 739. Your score is considered very good if your score is between 740 and 799. And just by the way, once you get to this level, then you're getting some of the best interest rates that are available when it comes to purchasing a car or buying a home. Your credit is considered exceptional if it's over 800. Just keep in mind is that you don't have to be in the exceptional category to get the best rates. So just keep that in mind when you're looking at your own credit score. But you definitely want to strive to be in the very good or higher arena. So the importance of your credit score is one of the most important numbers in your financial toolbox. Someone may run your credit anytime you apply for a loan or credit card, rent an apartment, or even apply for a job. A poor credit score can result in you being denied for loans or being stuck with much higher interest rates. And a good score can literally make the difference of tens or hundreds of thousands of dollars over your lifetime. So it can also result in you being turned down for an apartment or even a job. Think of it this way. When it comes to borrowing money, the higher your score, the cheaper the borrowed money will cost. This is also important when we're leveraging investments. If you can borrow money for less than you can earn on your investments, then you've created another opportunity to grow your personal wealth. The next area is looking at savings. It probably doesn't come as a surprise that savings is one of the most important components of personal finance, but most people simply aren't doing it. In fact, data actually shows that 39% of Americans, only 39% of Americans could afford to pay for a $1,000 emergency without taking on more debt. Only 39%. That means 61% of Americans could not afford an emergency of $1,000 without going into debt. The first saving priority most people should have is an emergency reserves fund. Your emergency fund can help you cover any unforeseen expenses. It can also serve as an income replacement in the event you lose your job. Many experts in the industry recommend having between 3 and 6 months worth of expenses saved in your emergency fund. If you're a business, that number may be closer to 6 to 12 months. Many businesses did not make it in the economy shutdown because they didn't have enough in reserves to make it through the pandemic. So if you're a business owner, you have to look at things a little bit more aggressively when it comes to your emergency reserves fund. The other type of saving you might do is for specific financial goals. Whether it's a dream vacation or the down payment on a home, having a regular savings plan will help you get there faster. Unfortunately, there's no magic bullet or secret to saving money. You just have to do it. When it comes to saving for a big goal, the best way to reach it is to divide the total number you need to save by the number of months you'd like to have it saved. That will tell you how much to save each month to reach your goal in your desired time frame. It also puts things into more perspective and reality. So if you have a big goal and that amount you need to save every month does not fit in your spending plan, you don't have to get discouraged. You can modify, either make more money doing a side hustle or extend your time frame to make that goal happen. But make it realistic that you can actually achieve the goal so that as you're going towards the goal, you don't get discouraged. The next area to look at is investing. Investing can be an intimidating topic for anybody, but it's actually one of the most important aspects of your finances. And why is that? Well, most people can't save enough money to retire. When I say save, I'm talking about just in your savings account. Instead, when you invest, your money compounds and grows at a much faster rate. The hope is that eventually compounds enough that you can retire. A lot of times people who do not understand the world of investing will simply save the money and set it aside. The problem is with low interest rates, over time, you're actually losing purchasing power, which is why investing becomes a very important component. A recent survey discovered that the average family believes they'll need about 1.9 million to retire comfortably. Unfortunately, the average family also only has about 255,000 in retirement savings. Luckily, by starting early and investing consistently, you can reach your retirement goals. Remember that you can also invest in non-retirement brokerage accounts, but make sure you're maximizing any tax-advantaged retirement accounts. Ideally, you want both pre-tax and post-tax investments to give you options when it's time to use the funds later on. So, investing 101. There are a few investing terms everyone should know before they start investing. The first term is asset allocation, how you divide your assets up across all your investments. Many times I'll ask clients or new clients coming in how they're currently allocated. So the idea is that you know how much you should have in, what percentage in stocks, what percentage in bonds, if you have a percentage in businesses, and other areas of investing. And most of the time, I would say 90% of the time, people don't know what their asset allocation is. The next area is your time horizon, the number of years before you expect to need the money you're investing. I've seen people make this investment mistake often because they're drawn to a higher interest rate or potential higher earning, but the time commitment was longer than the goal they were putting the money away for. So you have to really know what your time frame is in order to know what investments are appropriate for each financial goal. So you don't want to have a long-term investment if your goal is short-term, because there is the danger of market volatility. When you need the money, the market can be down when you actually pull the money out, which means you're working much harder than you need to. So make sure when you're looking at your time horizon that the investments that you're choosing matches the time horizon that you need. The next term is diversification, the practice of spreading your money across many different investments. So this may include stocks, bonds, real estate, fixed indexed annuities, overfunded life insurance policies, business adventures. There's a very long list here, but this is your area of diversification. So you want to make sure that all your money isn't invested in real estate. People that were overly invested in real estate saw the danger of that in 2008, 2009. Not just investing in tech stocks. People saw that when we had our tech bubble. So you want to make sure you are well diversified so that at any given time, your entire portfolio isn't at jeopardy. The next area or next term to consider is risk tolerance. This is your ability and willingness to lose money in the stock market. Okay, most people don't really know their risk tolerance until the market has a correction and money's lost. If you panicked and sold during March of 2020, you have a lower risk tolerance than someone who didn't panic and wrote out that short-term loss to make even more money over the long term for the rest of the year. So those of you that pulled out in March because you worried that it was going to continue going down, that was one of our shortest corrections in history. And we ended up having one of the best rates of return that year, despite having a 25% correction in the market. So you really want to look at your risk tolerance and what keeps you up at night. So a good investment in general may not be the right investment for you if it keeps you up at night. That's kind of a factor to look at. So you really want to look at your ability to lose money in the short term. The stock market is a long-term investment arena. Yes, people do make money in the short term, but in general, it's a longer-term commitment so that you can withstand volatility. The next term is home ownership. Most people do actually know what this is, but home ownership is one of the most common goals and financial topics. It's still considered epitome of the American dream. Unfortunately, a home is incredibly expensive. According to Zillow, the average home in the United States is valued at about $276,700. And depending on where you live, the local average can easily exceed that by hundreds of thousands of dollars. The median home price in San Diego County, which is where I live, is now more than $825,000. So here are a few things to keep in mind when it comes to buying a home. Only buy what you can afford. A general rule of thumb is that your housing costs shouldn't exceed about 30% of your monthly income. Unfortunately, lenders often approve borrowers for far more than that. And no one knows your financial situation like you do, not even a lender. So be sure that the monthly payment for your home fits comfortably within your spending plan. And remember, your monthly costs don't just include your principal and interest. You also have to account for home insurance, property taxes, and upkeep, which can be more expensive than people realize. So you want to save for a down payment to help out in this area. For most types of loans, you have to have some sort of down payment to buy a home. Down payments typically range from 3.5% for an FHA loan to 20% for a conventional mortgage. You don't necessarily need 20%, but you'll pay what's called PMI or mortgage insurance if you put down a smaller down payment. This, of course, increases your monthly housing cost. There'll also be other upfront costs in addition to the down payment. These include closing costs, a home inspection, and moving costs. Moving is so expensive, and you don't really realize that until you're in it. You also want to maintain a home emergency fund. So maintaining a home is expensive, and we generally recommend saving about 1% of your home's value each year for maintenance and repairs. In addition, this is in addition to your personal emergency fund. It's best to keep a separate emergency fund just for your home so you can easily afford any unexpected repairs. The next area is taxes. Taxes may be one of the most dreaded parts of managing money, but they're also one of the most necessary financial topics to be aware of. Because whether you realize it or not, if you're earning money, you're also paying taxes. But for most people, it simply comes out of their paycheck before they even see the money. You don't have to be a tax expert, but it is important to understand how much you pay in taxes each year, whether you're required to file a federal and state tax return, and what deductions you might be eligible for. Luckily, a good accountant or even good tax software can help you figure out those things. The last area we're talking about today is insurance. Insurance is typically one of the least desirable financial topics to discuss. But if there's ever an emergency, and chances are there will be at some point, you'll be glad you have insurance, and it'll be one of the cheapest coverages you have in your toolbox if you ever have to use it. I refer to this part of your financial plan or your financial toolbox as your financial security blanket. In general, buying insurance involves paying another company a monthly premium to cover your liabilities in an emergency. Types of insurance here to consider that you should have includes health insurance, homeowners or renters insurance, auto insurance, life insurance, disability insurance, and even an umbrella policy. And if you're a business owner, additional coverages are recommended. Just remember, the more you have in the way of assets, the more you have to protect against the unforeseen. So the bottom line is, if you're listening today to these financial topics and immediately feel either overwhelmed or realizing you haven't taken care of some things, don't worry. You don't have to have a deep understanding of each of these topics today, but the list will be a great starting point for you as you learn. You can reference it as you continue to do research and learn about each topic, and ultimately you'll be glad to have each of these important topics in your financial toolbox. And don't forget to take advantage of our complimentary consultation. Do not allow procrastination and or overwhelm to get in the way of implementing the financial topics we talked about today. So thank you, everyone. I will see you next week on Friday's Focus on Finances.